All right, welcome to the Explainer. Today, we're going to pull back the curtain on the tax system. We're going to follow the exact journey your tax return takes, right from the moment you hit file all the way to its final official assessment.
You know that feeling. You click submit on your taxes and it's like, where did it go? Did it just vanish into some digital black hole? Well, it might feel that way, but there's actually a super specific step-by-step process that kicks in right away. And honestly, just understanding that process could make the whole thing feel a lot less, stressful. Okay, so here's our game plan for today. First, we'll talk about the self-assessment system. That's the easy path. Then, we'll cover what happens when you need to file and fix a return. After that, we're putting things under the microscope with audits. We'll also touch on what happens when things get a little more complicated, and then we'll wrap it all up with the key takeaways for you, the taxpayer. All right, first up, the self-assessment system. We're going to look at how your return gets accepted, hopefully without any fuss. So the whole system is actually designed to run on something called self-assessment. What does that mean? Well, the law basically says, hey, if you follow the rules and file a compliant return, we'll just automatically accept your tax liability. It's really the default setting, It's built for efficiency for both you and the tax office. And you know what's kind of wild? It all boils down to just two simple steps for that automatic green light. First, you have to file correctly. That means your return has to play by all the rules in the book. And second, you've got to pay the tax you owe in full on or before the day you file. You nail those two things, you're pretty much on the express lane. Okay, but let's be real, nobody's perfect. What if you file your return and then have that sinking feeling, oh no, I made a mistake? Well, the system has a plan for that, and it's all about making corrections the right way. Okay, so you've got your original return, that's your first shot, your first submission for the tax year. But then you spot an error. Maybe you fudged a number on your income or completely forgot a deduction you were entitled to. No need to panic. You can file what's called a revised return. It's basically your official do-over, your way of saying, my bad, here's the correct info. But, and this is super important, that window to fix things doesn't stay open forever. The law gives you a very firm deadline, 180 days. You have 180 days from the date you filed the original return to submit your correction. Miss that deadline and, well, that door slams shut. And here's another key detail you can't forget. You only get one chance to do this. That's it. One revised return. So you really need to double check and make sure that one correction covers everything. Okay, now listen up because this is a huge rule. The second your original return gets flagged for an audit, your chance to file that revised return, it's gone. Poof, vanished. At that point, the game completely changes and you're playing by a whole new set of rules. And that brings us right to the part everyone dreads, right? The tax audit. The idea of having your finances put under a microscope. So let's pull back the curtain and see what actually happens when your return gets selected. So, an audit isn't just some chaotic free-for-all. It follows a really strict, legally mandated timeline. Check this out. Within just 7 days of your return being picked, the commissioner has to appoint an inquiry and audit team. Then that inquiry team is on the clock. They have 60 days to do their initial dig and file a report. After that, the main audit team gets 300 days to finish their investigation and submit the final report. It's all very structured. Okay, now here is a really fascinating little nugget buried right there in the tax law. The code actually gives you a way to lower your chances of getting audited. Get this, if your return shows that your total income is at least 15% higher than it was the year before, the law says it cannot be selected for a random audit. It's basically a reward for showing significant verifiable growth. Pretty cool, right? But, and this is a really big but, that 15% safe harbor has some major exceptions. Even if your income skyrockets, you can still get pulled for an audit if you're in certain industries, like banking or finance, or if you claim a tax refund, or if you have tax-exempt income. And another big one, if you've got large loans over taka 5 lakh from somewhere other than a bank and you don't have the paperwork to back it up. Any of those things can raise a red flag, 15% growth or not. So, we've seen the straightforward path and the audit path, but what happens when things get even more complicated? Well, the Deputy Commissioner of Taxes has a few other tools in their toolkit to formally assess what you owe. This table lays it out really nicely. You've got 4 main types of assessment. We've talked about self-assessment, that's the default, based on your own return.
Then there's the DCT assessment, which happens after an audit and is based on your return plus whatever evidence they found. Then you have the best judgment assessment. We'll get to that in a sec, but it's what happens when you don't file or cooperate. And finally, a provisional assessment, which is basically an early estimate if your return is late. Yeah, this best judgment assessment, this is the one you really want to avoid. It's basically the tax office's nuclear option. If you just don't file a return or you completely ignore their notices, the law gives them the power to figure out your tax bill using whatever information they can get their hands on. Trust me, you don't want them guessing what you owe.
Okay, so we've taken this whole journey from a simple filing all the way to the most complex scenarios. So what does this all mean for you? What are the absolute must-know takeaways from all this?
Look, it really boils down to these 4 key things. Number 1, file accurately. Do your best to get it right the first time because that self-assessment system is your best friend. 2, know your deadlines. That 180-day clock for fixing mistakes is real. 3, keep good records. I cannot stress this enough. If you ever face an audit, your records are your shield. And finally, number 4, respond to notices. Don't ever ignore them because ignoring them is a one-way ticket to that best judgment assessment we just talked about.
So there you have it, the entire journey of your tax return laid bare. At the end of the day, does knowing all the rules and the steps make the system feel more fair? I mean, understanding the roadmap doesn't change your destination, right? You still have to pay your taxes. But maybe, just maybe, it turns what feels like a shot in the dark into a path you can actually navigate.